Hello and welcome to the Investing with IBD podcast sponsored by Direction. It is Justin Nielsen here, along with the special weekly guest that we always have every week, Arusha Pires, O'Neill Global Advisors portfolio manager. How are you doing, Arusha?
I'm doing well, Justin.
Excellent, excellent. So it is September 14th, 2022, and we are very glad to welcome back to the show Simon Erickson. He is the founder and CEO of Seven Investing. How are you doing, Simon?
Great, Justin. Glad to be here. Glad it's football season again. A lot of good things going on out there right now.
Yeah, that's right. We should have had you on the show last week. We were talking a little bit of football with Jared Tendler. So yeah, it's and I know you're a big Saints fan. You have your paraphernalia that you were showing us earlier. So
I had to get that into the program. These are some
Yes.
nice picks with the
Yeah,
Saints
maybe bring it up a little
forward.
bit closer to the camera so we
Right
can
there,
see
right?
the logo. Yeah, there we
yeah,
go.
that's an awfully good looking shoe there. So
Blue
um,
day.
so yeah, big shoes to fill, Simon. We're can't wait to hear about your thoughts on this market. We had, of course, a big CPI report yesterday, and a big market reaction to it. But we're also kind of looking ahead to what areas may be setting up, what areas are looking interesting. So we're going to do a deep dive with Simon on that, and of course, Simon's also going to share some of the stocks that are on his radar. So let's get right to it and throw up the Nasdaq. That 5% drop on the NASDAQ composite after the CPI report came in a little bit hotter than expected. That was the worst drop that we've seen since June 11th of 2020. What do you think, Simon? Is this time to go back in the bunker with canned goods and not come out for 6 weeks and maybe we get winter, or that's Groundhog Day? What's your take on this whole thing?
Beef jerky and ammunition and run for the hills of Montana, Justin. That's my
Yeah, okay, but there we go.
And has it been more than 6 minutes since we mentioned Jerome Powell? I feel like we haven't talked about the Fed in at least 6 minutes now. Probably the all-time record for the last 6 months.
Yeah, seriously. I mean, it's one of those things when you get a bunch of people that are technicians talking about macroeconomics, it's like, okay, what is going on? So, what's your take with everything? Do you even care that much about the macroeconomic picture, or is it more just the market's reaction to everything for you?
Yeah, it's certainly the macro matters, right? And I think that I'm in the majority here when I say that with interest rates going up, discount rates are increasing, future cash flows that are discounted back to the present are worth less. So all things considered, stock prices are worth less when you have a restrictive environment from the Fed. I think that the bigger story that's kind of making all the headlines right now about inflation is, which industries are going to be most exposed to this. If you're shipping things around the world and you're very exposed to gasoline prices, yes, this will certainly impact you. If you are selling directly to consumers, consumer discretionary, even the advertising industry, which is tangential to that, yes, this will certainly impact you. If you're selling enterprise software and you've got 98% retention rates with really, really big customers who have deep pockets, maybe this is not as concerning for you. But it's certainly a stock picker's market in my mind right now. It's not just across the board free money for everybody. We can throw darts and get a great return over the next 10 years.
Right.
Now,
to your point about the software companies, I mean, a lot of these software companies got hit so hard because all of a sudden it was like, oh, PEs matter now, and a lot of these had those higher valuations. So while they might be in a little bit of a better stance, in terms of shipping and everything like that, hey, it's a lot easier if you're just downloading software. Some of them still have fairly high valuations, even though they're off their highs by 50% or more. So do you think that that's, what is that? Who wins in that argument? Is it the high inflationary environment with the discounted future cash flows, or is it the competitive advantage of not having these rising costs with shipping and other things?
Yeah, there's generally three ways you can make money in the stock market. Growth in fundamentals, growth in valuation multiples, or dividends, right? Ignoring the third of those, just focusing on the first two for a moment here. We can look for companies that just are growing earnings and growing sales 100% every single year, and the market still values them comparably with how it has traditionally for the last couple of years. That's one way you can make money. The other is that you have a very cheery consensus where the market says, hey, I used to be paying 10 times sales. I'm going to pay 20 times sales now, and maybe I'll pay 30 or 40 times sales. And I think with all the IPOs that we saw pre-COVID, and then also a lot of the optimism that we had post-COVID, especially in the tech industry right there, we got some really frothy valuations that are kind of, I think, coming back down to earth right now. And so I think that, well, maybe there was a little bit of, froth of optimism in there in the last year or two. I don't think it spells doom for the tech industry long term. It's just that, the market's going to do what it's going to do on any given year. If you're thinking 3-5 years out, things like this tend to normalize.
Now, does this change your strategy? Because you're definitely looking. We're all looking for growth, right? And we're all going to get into these growth stocks, and we're going to hold them at different time frames too. But does this new environment, does that change your kind of approach for looking for innovative, great growth companies that a lot of times are going to be more expensive? They're not going to have those cash flows initially. They're not going to be earning for a little while.
The innovative, great growth companies is the perfect description of what I like to look for, Arusha. I'm a long-term growth style investor. And what that really means is I'm trying to find things that are mispriced right now. Starbucks is very easy to model. You can kind of figure out how many people are going to Starbucks every quarter and how much they're going to increase prices for. Same thing for a lot of retailers out there. For an artificial intelligence-based company or a company that's playing around with blockchain or looking at new markets that didn't exist before, a lot of times the market has no idea how to value those companies. There's some that are going to say, hey, I want to be the early, adopter. I want to get on this early. And others are saying, wait, I'm not in on this till you show me the money. And I try to find the happy medium between those two, where we find things that look promising, they look innovative, but they're actually showing progress too. That's the sweet spot for me as an investor. That's the kind of companies that I like to look for.
Well, now certainly in 2021, starting in 2021, and then for the first half of 2022 in a big way, it was a lot of the cyclical stocks, the materials, the oil, the gas. And I mean, you look around now and oil and gas, I mean, that's not dead. That's some of the best looking charts out there right now. That's not exactly what we normally think of as this innovative and growth type of industry, but in a lot of ways, that's what the market is favoring right now. So do you do any shifting yourself, or do you just say, hey, I'm going to wait until my stuff gets back in favor, and I'm just not going to play these that are kind of outside of my norm?
Tend to look at the industry as a whole, Justin. So like you just mentioned, oil and gas, I kind of would consider that as energy. And we can actually find pockets of energy. We're going to talk about a few of them on the program here today, that even as oil and gas, looks really good right now, the Exxons and the Chevrons of the world, there's also some pockets that haven't gotten a whole lot of attention in the past that are really starting to get some really good interest, I think, from investors as well. Software is always innovative. It's one of the fastest changing sectors of the market. Cybersecurity, here to stay. Companies like this that are deriving revenue from the acquisition cost versus the lifetime value of a customer, and things that are digital, that's a lot different than assets that are in the ground when you're putting steel into the dirt. It kind of is a different kind of ball game that you're playing. As investors, though, we should always think about cash flows and how that actually impacts us as the investors in these companies.
And so, Justin, maybe we probably should go back and talk a little bit about just the overall market.
I was thinking the same thing.
IBD perspective, just to maybe end this segment.
Right.
Because we are obviously we're still in this more volatile, more bear market correction, call it whatever you want. It is a much trickier market than we've seen for quite a while. And we had the sell-off yesterday with the CPI numbers. Today was just a very, very weak bounce. And the overall market outlook is under pressure, right? So really, nothing has changed that much for much of 2021, or 2022. Not a lot has changed. Still very tricky. Still be cautious. Don't push it at this time, at least from the IBD perspective.
Yeah, and I mean, one of the things that we were talking about with Simon and kind of our prep call was, we were all kind of giving our projections. Okay, what do you think is going to happen here? And I've been kind of thinking for a while, hey, we could just go back and forth here for a while, and we are still doing that. As of right now, the September 6th low has held. You can see that, from just last week, and that's kind of lined right up with the July 26th low that we had, where it, the NASDAQ just briefly came in to its 50-day moving average line before really taking off in July and August. But of course, there was that 200-day moving average line, and as soon as that kind of reared its ugly head, The Nasdaq didn't quite get there. The S&P 500, almost touched it and turned away. And so here we go again. Not that we're necessarily going to make new lows, but one of the reasons why we didn't go to confirmed uptrend, even though there was a really strong 4-day rally, was, there was no volume behind it. There was no follow through. There was no conviction. And especially if you compare it to just the week before, where there was a lot more downside volume, you kind of want to see that reversed. Simon, on your side, are there any particular levels that you look at on the chart that, like, hey, if I see the indexes do this, I'm going to feel a little bit better? Or are you just really looking at more of the sectors and the industry groups and kind of making your gauges based on that?
A little of both. I actually really have a great amount of respect for the technical analysis that you guys have done. I love this show. I actually love learning from Arusha for several years about it. Now, we talked about 7 predictive indicators this morning earlier. Everything from the S&P 500's PE ratio to the cyclically adjusted PE ratio to the Buffett indicator to the 10-2-year yield spreads, just things like this. I think that they all boil down to, though, what is the confidence that the market has in American businesses? Whether it's actions from big money that's being put to work or being pulled out of stocks by institutional investors, or if it's broader indicators that indicate what is the valuation of the stock market as compared to the success or lack of success of the American business. At the end of the day, it's people are all looking for a little bit of confidence, a little bit of trust. Jerome Powell, see, 5.5 minutes there, Justin. Almost like
there we go.
Like, when we talk about these things, it's like, when are we going to get that confidence back? I don't think anyone really has the great answer to that, but I don't think it's permanent that things are going to stay under pressure like this.
Yeah.
Certainly, something else we talk about is short interest. Which is very high for some of these companies right now. Yeah.
Mm-hmm. So maybe talk a little bit more about that, because you were bringing up some interesting things on the short interest. Is it getting overdone on that side? Has the bearishness gotten too much?
In pockets, I think it has. It wasn't just more than a couple of weeks ago that we saw Invitae go up 270% in a single day. The stock almost quadrupled in value just because of a short squeeze. There's some technical factors that go behind that. People tend to go running for the exits if they're betting against a stock that has a catalyst attached to it. But the short interest says, of all the freely traded shares that are available out there for the public, what percentage of them are people that are betting against the stock, that want the stock to go down? And for a lot of companies, it's pretty healthy to see a 7-10% of the free float being sold short. We're starting to see some of these companies, especially in the tech industry right now, popular companies with great leadership teams, 30-40% or higher short interest. For me, catalysts, a buyback, a good earnings report, a shakeup of the board of directors, things like this can become very, very bullish in short periods of time, even for great companies.
And easily cascades. A little bit of buying here starts even more buying, and then the panic kind of starts, and before too long, you've got 200% gains in a day.
Exactly. Yeah. Well, a lot of times, because it's interesting though. A lot of times, because people will ask how we look at short interest. Usually, I don't pay too much attention, especially when the stock is in a downtrend. But when a stock is setting up for one of the patterns that we look for, and there's a lot of short interest in it, and they're going into earnings, a lot of times I'll say a prayer for those who are shorting the stock, because if that earnings report is good, they are going to get run over. And it's amazing, especially a lot of the stocks that we look at, all of us look at, right? These innovative stocks that people just naturally will bet against because they don't see necessarily the bigger vision when everything lines up with the market and all this stuff. But when that all lines up, they're betting against it. They'll get run over, and that the shorts covering is a big part of that catalyst to really get that stock going into new highs and really start trending on its way up to a pretty good run.
Mm-hmm. So basic synopsis, uptrend, still under pressure, still a lot of back and forth action. This is one of the things that, at least for our shop, we tend to not predict too much of saying, hey, we think that the index is going to be at this level in 6 months or do this. We just basically say, okay, what is it doing right now? And right now it's a lot of back and forth action, and hard to make any progress, really, unless you're in the right industries. And when we come back, we're going to talk about one of the industries that is on Simon's radar in a big way and why he thinks it's worth doing a deeper dive. Stay tuned. We'll be right back. The Direction Hydrogen ETF offers exposure to the top 30 pure-play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive. Okay, welcome back to the Investing with IBD podcast, sponsored by Direction. It's Justin Nielsen here, along with my weekly guest, Arusha Peiris from O'Neill Global Advisors. And our special guest this week is Simon Erickson, returning back to the show. He's the founder and CEO of 7 Investing. Simon, let's talk a little bit more about what industry you think could be the next big thing.
I believe we referred to it as powering up the electric vehicle industry, Justin. At least someone who's a lot more clever than I did came up with that slogan for it.
Right.
But, this is one of those that's getting a lot of attention in the market, right? We talk about EVs a lot of time. We talk about Tesla a lot of time. Feels like the rest of this industry is catching up with Elon. And maybe it's time to start talking about the picks and shovel plays and the companies that are at the forefront of that as investment opportunities.
So let's start talking from kind of the larger perspective, kind of the what's going on from the higher level, and then we'll get into the specific stocks a little later. So what's going on with the EV? What are kind of some of the areas that are growing really fast right now?
Well, I have 73 technical diagrams that I'm going to share now with everybody, Arusha. So as long as you guys are okay for the next 2.5 hours, I'll just start up my PowerPoint, no problem. People are either going to love or hate this podcast, I tell you. Just kidding, of course. The bottom line is, though, that this is there's some fundamental science that's different. We're not just talking about incremental improvements to gas-powered cars anymore. Electric vehicles that are powered by batteries are completely different than them. They require completely different supply chains. And this thing that we've become comfortable with knowing as the car that we've optimized for the past century is suddenly changing. The people that are fans of electric vehicles are, first of all, fans of batteries. They are greener. There was kind of a lot of attention up front about the decarbonization, all the green efforts, the ESG, things like this that weren't associated with fossil fuels. But there are also others that are really a fan of just electric vehicles being more efficient, too. The efficiency of the internal combustion engine and how that delivers power to the rest of the car is inferior to electric vehicles. And so I think those are kind of the two topics that maybe we can chat about as investors, because there's companies that are kind of going all in, pure plays on both the battery side of this and then also the how is the power delivered to the car, which to me are pretty interesting and pretty innovative.
Now, we should mention to folks, Simon is not just a pretty face. You actually did get a degree in chemical engineering, so you kind of know a little bit about the engineering side and some of the chemicals that are causing these reactions to produce this energy and everything. So thereby your 72 diagrams that you'll be showing us very shortly, I'm sure. So maybe kind of break it down for us a little bit. Of course, everyone is talking about lithium. It's you see that everywhere. And is that the be all end all, or are there competing things out there? And even with lithium, you've got kind of different factors of lithium. You've got the lithium carbide, or what do you see as being kind of the winner right now? And are there some contenders waiting in the wings?
It's interesting, Justin, because we go back just a couple of years. It was not that long ago that Elon Musk couldn't get anyone to show up for his booth. When Tesla was a new company and he was saying, hey, we're going to have this Tesla Roadster, this $100,000 electric vehicle that's going to be awesome. A lot of people were saying, that's really not going to work. In fact, Elon himself was saying that Tesla had a less than 10% chance of being successful. And now it's, more than $1 trillion company, one of the most popular companies and investment opportunities out there. But what Elon really did was he scaled up lithium ion chemistry. He found a battery that was good enough for electric vehicles to go mainstream. When we say mainstream, the mass market demands certain things. If you want to have it something that's going to replace the car that you already have in your garage, right? It's got to make sure that it's not going to run out of juice right? When I'm driving to work, I can't be stranded on the side of the highway because I ran out of charge in my battery. And then if I do want to charge it up, I don't want to spend 2 hours sitting at a charging station. I want this thing to be charged up in 15 minutes, preferably even less than that, probably. And then also, battery packs are expensive. Electric vehicles are expensive. I don't want to have to replace this thing after 50,000 miles. I want it to last for 300,000 or 400,000 miles. And so Elon did a lot of good things with lithium ion as the technology that's powering all of Tesla's battery packs right now. But the people that are really, into the science and into the technology have said, hey, lithium ion goes back to the Arab-Israeli war. I mean, this is a technology that's been around for 50 years, excuse me, and we're incrementally improving it a little bit more every year, right? Tesla's getting a little bit better, Panasonic's getting a little bit better. But guys, if we really, really wanted to flip the script on this, there's an even better technology called lithium metal, which is highly unstable. By the way, it tends to blow up. Bad things tend to happen. But if we could fix a lot,
that's not encouraging. I'm thinking of the Ford Pinto now.
Bad publicity when your car blows up. But there are now companies that are actually saying, I think that we've figured out a lot of these limitations and problems with lithium metal. It's got a higher energy density. It's got a faster charge time. It's got longer durability for more and more cycles. And as these things that were R&D considerations 10 years ago start getting into commercialized aspirations today, the companies can bring out to the market and actually start selling cars that might not have the same battery pack as Elon is making in the gigafactories. Mm-hmm. We should pay attention to things like this. At the end of the day, innovation tends to win. We're not driving Model Ts anymore. There's not steam-powered vehicles driving around on the roads. But it's an interesting one that's going to take some time. But I think it's fascinating and very interesting as an investor.
How long do people think that it will become much more commercial? I mean, like how has it been where has it been introduced right now? And then, what's kind of the timeline for this to potentially become a viable alternative to lithium ion?
One of the companies we'll be chatting about in the third segment here has got partnerships with about 5 of the 10 largest OEMs in terms of sales within the United States. What that means, Arusha, is that nobody wants to get caught behind their competitors in this. If there's a better battery where you can buy a Ford car and it's going to get you 600 miles before you have to recharge it, but your best electric vehicle can only go 300 or 400 miles, what are people going to vote on? They're going to put their money where their mouth is and go with the performance. And so when these things tend to happen, they tend to be science experiments at first. Then they hit a critical mass, and then you see this S curve, just like we saw with Tesla's S curve, that they take off in very short periods of time. That can be 10 bagger and maybe 20 bagger potential for investors that catch them at the early stages.
Mm-hmm. Now, how much of this innovation, look, capitalism, it's all about creative destruction, right? But it makes me think of back in the day when you had the VHS and the Betamax, right? And then, you eventually had the laser disc was in there at some point, DVDs, Blu-ray, all of this. Sometimes there were growing pains, right? It was like, who's going to be the winner? First of all, where do we need to put our money? Because at first you don't know. There's competing technologies and you don't know who the winner is going to be. Betamax, a lot of people argued, was the better technology, but it didn't win. So with this different battery technologies, number one, how do you kind of adjust to, maybe this one is the more commercially viable? And then number two, does that create changes in supply chains, production, all of those things to make that shift to say, okay, now we're going this way because this is the better technology? Or do you stick with the old technology because that's what you kind of put your money into, the CapEx expenditures?
You close your eyes and throw darts, Justin, right? You just kind of blindly say, okay, we're going to go with this one today. Yeah. It starts with scientists, right? It starts in the lab. Somebody comes up with something that's interesting. They put it out there for venture capitalists to take a look at. All of a sudden, you've got some big name, Kleiner Perkins types of Sequoia venture capitalists that are putting some big money into things through later and later rounds. These companies go public. There's, mass market brand recognition of companies like this. And then you've got commercial milestones that happen one step at a time. It's not just jumping in the deep end of the pool and doing a high dive, cannonball, and then all of a sudden things happen. It's the result of decades of work. And we are starting to see, I mean, we were first talking about batteries, but, lithium metal and even lithium ion too, have been lab experiments for long periods of time. We should not understate how much Elon Musk had to do with this, because he didn't want to disrupt his own business. If you're Ford and you've been optimizing your cars based on the internal combustion engine for a century, you're not really eager to go out there and give up all your margin to try something new. But if you get pushed by a disruptor that's getting a lot of attention, just like Tesla has, all of them are, every OEM now is wanting to make sure they're not getting left behind. There's businesses and employees at stake on this.
So including Tesla, they're definitely have some people working on lithium metal just in case, that becomes the technology.
Yeah, and disruptive innovation always says, Arush, it's tough to beat the incumbent at their own game.
Right.
It's hard to come out there and have a lower priced, better performing microprocessor that's a CPU that's going to compete against Intel. It's hard to have a more efficient gas powered engine that's being put into the cars is going to get better highway gas mileage. But if we're starting over, if we're using batteries and we're using drivetrains that are completely different than what we've got right now, if we're looking at traction inverters that are distributing that power to the rest of the vehicle more efficiently, all of a sudden it flips the script on a lot of the things that we've kind of held sacred for a long time.
Mm-hmm. So, maybe let's get into that a little bit more, because you did talk about, getting back to your original energy, and there's a lot of ways we can define energy. Are you getting it from fossil fuels? Are you getting it from electric? Are you getting it from lithium, chemicals, what have you? But there's that traction inverter. Can you talk a little bit about that efficiency with which the power ends up turning the wheels?
Yeah, that's exactly, as efficiency is the right word for this, right? We're looking for decades about putting liquid gasoline into our cars, input, and then the output of that is spinning the wheels, right? I step on the accelerator on the highway and all of a sudden I'm up to 60 miles an hour. How many seconds can you get me there, right? Gas-powered cars are not really that efficient. We've kind of talked about the range of 40 to 50% efficiency in terms of the energy going in and inputs versus the output of turning the wheels of our car. But Elon and others said, electric vehicles, if we're doing this where we're actually producing DC power out of a battery pack, turning it into alternating electric current that's used by the motor of an electric vehicle, AC power, not AC DC the band, but DC to AC, for these cars, we can get up to maybe 80 to 90% efficiency, double where we were at before. And we also said, if there was a different material that we would use in the chips that's helping to distribute that power across the vehicle in a more efficient way, we could probably get up to 95 or even 97% efficiency.
Wow.
But it's going to take a different type of chemistry. It's going to take a different material that's going into the chips. That material is silicon carbide, which is being used in Tesla's traction inverters that are giving its vehicles 97% efficiency today. And so Tesla's been the early leader in this field. It's, again, a picks and shovel play, but others are catching up, and there are other companies that are doing this even more efficiently than what Tesla's doing right now.
So for Simon, for the lame, just for the layman, how does having that much more efficiency affect their lives? It's just going to cost less to get the same amount of work done. I mean, translate that into like something that I can understand.
At the end of the day, if I'm making a battery-powered car, I want it to be as light as possible, Harish. Okay. I want the smallest battery pack I can put on there, because more weight means you got to slow down when you're driving 150 miles through an hour through California, right?
Yeah.
Just kidding. No one ever did that in LA, I don't think. 10 miles an hour on the highways? But at the end of the day, it turns into specifications, right? Lighter weight, better energy density, more efficient power distribution across the car. I mean, things that are, just specs for R&D guys translate into dollars and cents of something that could be a competitive advantage.
Yeah.
And so there's kind of, these different types of companies. There's companies that are providing the batteries that have higher energy density. There are companies that provide the power modules or the traction inverters that are components that go into a Tesla or another electric vehicle out there. I mean, when you're starting from scratch, again, it's okay to be new, because you're doing something fundamentally different than what everybody else is doing out there.
Well, now maybe we can just kind of wrap up this discussion with one other component, and I'd just love to hear your thoughts on this, Simon. one of the things that's, I guess, difficult about replacing the internal combustion engine is that there's this whole infrastructure with gas stations, right? And they're all over the place. They're readily available. Now you have to replace that with charging stations, and how readily available are those? How frequently can you run across them? I mean, I know driving up the 5, sometimes I'm like, okay, it's 30 miles until the next one, and if that one's closed, then when is the next one? That's 30 miles. With some of these charging stations, it could be a lot longer that you have to go, and you have to really kind of back into, where am I going to stop? How long am I going to have to stop for to charge? And how efficient is that going to be? And will is the charging station going to be there? Is it going to be available? And is it going to be working? So
you're giving me
maybe you could
range
talk
anxiety here.
yeah, right, exactly. So maybe you could talk a little bit about that side. Is there, is there anything that you're calculating on that side and looking towards?
There's two sides to it, Justin, right? There's one side that's the political side of it, and then there's one part of it that's the commercial side of it. The political part, I really can't comment on. I don't know. I don't know where the money's going to go to. We talk about, infrastructure for supercharging stations. We talk about R&D grants, proposed by the presidential administrations, things like this. There's hundreds of billions of dollars that's committed now to R&D science, fundamental research that can go into things like this. And a lot of that subsidizes businesses to do really neat things when they can get, some money from the government to reduce their own capital costs. But the perspective I've always taken as someone who worked at a tech ventures division of one of the large 10 largest companies in the United States was, we always looked at, without subsidies, if you didn't look at the political side of this at all, and you just looked at the technology and let that make your decisions go forward, which ones do you really want to bet on? And 9 out of 10 don't go anywhere, right? You'll go out and you'll even put money into things that are not going to be the end winner. But you have to take bets, and then you have to kind of consolidate across those bets. It's very hard to go from 0 to 60 in terms of commercializing things without kind of taking incremental steps along the way. And I think that's where we stand with a lot of these, that they are, again, progressing out of the lab, getting some scalability prototypes that are now getting into programs with really big customers out there. The next step's going to be, are we looking at companies that maybe are $1 billion today, maybe $5 billion today, that are worth $50, $100 billion in the future, because that's what the auto industry can support. There's a lot of cars that get sold every single year across this country.
Mm-hmm. And I mean, we should also mention, and this is one of the things we've been kind of talking about, especially here in California, we've had this major heat wave, and it was like, hey, don't charge your cars. And it's like, well, wait a minute. You're telling us that we have to switch to electric, but then you don't want us to charge them. There's you're a chemical engineer. Help me. How does that work? Explain the physics to me.
Turn the AC off, right?
Right.
It's a trade-off, right? I mean, you've got California saying, yeah, no more gas-powered cars, but then you've got brownouts throughout the state. It's the political side of it. It's always challenging. It's two cars driving alongside each other on the same highway, which helps certain technologies catch on.
Yeah. Okay. Well, when we come back, we're going to talk a little bit more about some of the innovative companies that are these picks and shovels plays that might be worth doing a little bit of a deeper research into. Maybe not for right now at this moment, but things that are looking good in the future. Stay tuned. We'll be right back. The Direction Hydrogen ETF offers exposure to the top 30 pure-play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive. Welcome back to the Investing with IBD podcast, sponsored by Direction. It's Justin Nielsen here, along with my weekly guest, Arusha Pires from O'Neill Global Advisors. And our special guest this week is Simon Erickson, returning back to the show. He's the founder and CEO of 7 Investing. And, we should just real quickly mention before we get into some of these stocks, that people can follow some of your ideas here. Maybe you'll throw up those 72 technical charts on your Twitter account. That's at 7 Innovator. That's the number 7 Innovator. Anywhere else that people should reach out to you and kind of get information on what you're looking at?
We do, Justin. We will not put those 73 charts up on this page, but 7investing.com/subscribe if you do want to see our 7 top stock market recommendations every month, I've got a fantastic team with me. We'd like to pick stocks out there. If you use promo code IBD, you get $100 off of the annual membership. So 25% discount for your listeners of your show.
Very nice. Okay, well, let's get into some of those top 10 ideas right now, at least a few of the ones that are mulling around in your brain. And why don't we start with QS, QuantumScape. Now, of course, this one is, gosh, almost 75% off its high. You mentioned how there were all these IPOs in 2020, and I mean, it got even more frothy in 2021, especially with the special purpose acquisition companies, the SPACs, as they're known, going really crazy. I mean, 2021, I think, was surpassing 2,000 to make a historic high in terms of the IPOs and SPACs. So what is it about this that's exciting you, and why is it that the market's not recognizing it yet?
Oh gosh, Justin, the most exciting part was probably back in November of 2020, right? When it actually does that SPAC IPO, $10 a share, and within 1 month, it's a 13 bagger. It's up to $131 a share.
It's just that easy.
My goodness, I should be buying. If I had bought, I could have retired with an island in the Caribbean now. We could have been hanging out there.
You could have had so many of those Saints shoes. It would have been like
stockpiled, right? The enthusiasm was from all the mumbling and grumbling about lithium-ion batteries. They're just saying, electric vehicles aren't going to get out there. It takes too long to charge them. You know, the range anxiety that Arusha talked about. I mean, and then right at the SPAC IPO that QuantumScape had, Jagdeep Singh, the CEO, basically says, hey, we can fully charge this, almost fully charge, 80% charge this within 15 minutes. We can fix the dendrite issue with lithium, with the separators. That has been a problem that's causing them to blow up and degrade over time. And by the way, the energy density is superior to that of what Elon can have with Tesla. And so everyone got so excited about this right out of the gate. And then they kind of pulled that back and they said, well, you know, actually, these are still prototypes in the lab. We're not going to actually have anything commercialized until 2025, probably 2026. And so market kind of lost a lot of that enthusiasm. Shares are back now to exactly about where they did at that IPO from 2 years ago. But the interesting thing is that the company is making some pretty solid progress. They have 6 partnerships in place with large OEMs that are automotive OEMs that, again, are saying, hey, rather than us develop this ourselves, we'd like to hire you to do it. And let's build a program around this that we could eventually put into our own electric vehicles. The other really interesting thing, Justin, is that JB Straubel is on the board of QuantumScape. And if that name is familiar to anyone in the audience, he was the chief technology officer and a co-founder of Tesla, who has now said, you know, years later, hey, I'm abandoning lithium ion because I'm going to go out and figure out this lithium metal chemistry and how this can be even superior to what's out there. Elon, of course, says this is impossible. He says, you know, there's no way that you guys can scale this up from the lab to something that's global. But QuantumScape is certainly up for the challenge.
Challenge accepted. And you know, another thing you just have mentioned a number of times, the acronym OEM. So just for people that don't know, go ahead and fill us in on.
Original equipment manufacturer, the people designing the cars, but then they'll also contract others to develop components that go into those cars, like a battery pack, like a traction inverter.
Okay. Go ahead, Arusha.
Have they given more insight on when some of these might become more commercially available and, you know, a little bit more mainstream?
Their predictions that they said straight from the IPO, they've stuck with. They think that they're going to be able to sell 100 kilowatt hour battery packs at $7,000 per battery pack to 910,000 vehicles by the year 2028. That's about the same price as Tesla's lithium ion battery pack today, but with superior performance. I've done some I've done some research on this and leveraged some third-party research as well for Arusha. I think by 2030, they get to 1 million vehicles a year that they're supplying the battery packs for. And I'm actually going to give them the benefit of the doubt. I think they're going to sell them for about $10,000 for the improved specifications. If that's the case, you're talking about a company that could be doing $10 billion in revenue by the end of the decade, so 8 years out. And if we give them even a 7 price to sales multiple, half of what Tesla said, because they don't have the interrelationship with the consumer, they're selling to the automakers themselves. But even at a price to sales of 7 times at $10 billion a year, you're talking about a $70 billion market cap company that's selling right around $5 billion today.
Yeah.
So the market has this inefficiently priced. Either it's going to fall apart, this doesn't work, and we just keep sticking with lithium ion, Or if it does, even with conservative assumptions, this could be a multi-bagger for investors. I just wouldn't recommend backing the truck up just yet. There's a long way to go and a lot of risks on this one.
Yeah,
Well,
I was just gonna say that. I mean, if it's 2028, right, 6 years. I mean, that's a long time to park a lot of money. Maybe you have a little bit of money in it if you really like the story and believe in the company that they can pull it off. But it's a long time to park money in it and hope things work out. And that's a long time for another competitor to come in and potentially come up with something else that could completely reduce the impact of lithium metal.
Yeah, they've got a three-part partnership for most of the OEM, the audio makers that they're working with. So call it A, B, and C. They just announced that they've made progress on the 24-layer cells, which qualifies for the specifications that a lot of their partners have put in place for those sample A cells. In other words, if there's a three-part program, they've got something that might be showing promise in part A. Which is great. They're making actual progress out there. It's not just a pie in the sky pipe dream idea.
hmm I was actually going to ask you that because just kind of hearing you talk about this, and you look at the numbers, and when you immediately see NA everywhere, it just reminds me of those, kind of the biotechs, right? Where they don't
Right.
have, they're trying to build something. They've got an idea, they're trying to build it. They have to go through the clinical trials and all of that process before anything actually goes to the market, and then you'll see, okay, does it work? And so are there kind of, again, with biotechs, you maybe have these clinical trials, these approvals, these milestones that they hit. Is there anything kind of similar for QuantumScape where they're letting you know, okay, we hit this milestone here, and this is our next one, and if we can do this, then we're on track? Or, oh man, if we miss this one, then maybe this isn't working like we thought?
Yeah, binary events, Justin, right? It's a
Yeah,
0 or
right.
1, right? It's a heads or tails.
Yeah.
Just like the biotech stuff you said. Is it going to get through clinical trials or is it not? There is a 0% chance of the Houston Texans winning more than 4 games this season. I mean, things like that. It's either a yes or a no that are the outcomes. I think of QuantumScape as like a mini biotech that has 6 different paths, right? If it's got 6 partnerships and one of them doesn't work out, it's still got 5 partnerships. But then you kind of got to discount back the potential cash flows from that one that didn't work out are no longer on the table. Somebody says, no, this isn't working for us, we're abandoning it. You're going to see a lot of volatility around the stock, just like you see with volatility in clinical trials for a biotech company.
hmm So that kind of covers QuantumScape to a large degree, and again, the potential there. Let's kind of shift a little bit more into the semiconductors, away from the original equipment to semiconductors. And now, granted, semiconductors have been hit pretty hard, but you've got a couple semiconductors that it's almost like what correction? They're almost at new highs. So we can start with Wolfspeed. Now, folks might be familiar with the old company Cree from back in the day. That was one of the stocks in the 90s that was a big winner. So what has Cree turned itself into with Wolfspeed?
Completely repivoted the company, right? Cree used to sell LED light bulbs to consumers, and now Wolfspeed is all in pure play on silicon carbide materials. Example that might be kind of people would find this similar to would be Intel. Intel can make wafers, silicon-based wafers, for its own microprocessors, or with its foundry group, it can contract to make your chips as well, right? The whole semiconductor industry has been based upon silicon as the wafer material for semiconducting properties. And just over the years, we kind of said, yeah, this is great. It makes sense that, the manufacturing processes and the fabs that Intel and Samsung and everyone else has built out there, yeah, they're really good. They incrementally get better every year. But what if we used silicon carbide instead of silicon as the wafer material? This is a wider band gap material, which means that at higher temperatures, it can still allow the flow of electrons more efficiently and with less resistance than silicon can by itself. Why does that matter? Well, for an electric vehicle, if you punch it and you want to have all of a sudden a lot of energy being delivered to the vehicle without a whole lot of inefficient losses, that really matters. And so Wolfspeed is saying, hey, all those forecasts we just talked about with QuantumScape, all the electric vehicle companies that are wanting to push their own models out there and have the most efficient cars that are out there, guys, you've got to have this based, the chips in your cars have to be based upon silicon carbide. And we know you're going to get there, and we know you're going to figure this out. And we're going to start building the giant facilities to make that a reality. And so just earlier this year, they put $1 billion into Mohawk Valley in New York, American manufacturing of silicon carbide. That's going to be fully operational in the next 2 years. And they also just announced that they're also going to be putting another $1 billion into the expansion of their North Carolina facility. Justin, this makes them the largest independent manufacturer of silicon carbide, kind of a pure play that's all in on a market that hasn't fully recognized its potential just yet.
Mm-hmm. But is the demand just dramatically increasing? So, I mean, the solution sounds amazing, but has it convinced kind of the big players to maybe slowly start switching from silicon to silicon carbide?
I've got an example for it, Arusha, of one that's actually out there that we can actually see driving around today. It's not just, in the future kind of thing.
Yeah.
Lucid is an electric vehicle maker, right? This is a premium segment of the market, right? These things sell for like $90,000 a pop. But the specs on them are pretty awesome, right? Like they can say that some of their vehicles can have up to 1,000 horsepower, go 0 to 60 in less than 2 seconds, Arusha, and have up to 200 miles per hour, right? This is a sexy EV. This is not just the golf cart that you're driving around your neighborhood. But that's made possible because Lucid is partnering with Wolfspeed today to produce a lot of the power components that go into the traction inverters that allow for that efficient distribution of the power supplied by the battery, that when you punch it, it goes really, really quickly and really, really efficiently. Tesla figured this out years ago. They did not work with Wolfspeed. They worked with a company called ST Microelectronics. But again, designing traction inverters, those are now going into the Model 3. The rest of the industry is trying to catch up with what Elon figured out a long time ago.
Yeah. So now, what is it about Wolfspeed that, again, it's kind of still early on. Correct me if I'm wrong. This is kind of still early on with adoption. So how much adoption has been done already, and how much is it looking towards in the future, especially if QuantumScape kind of gets its stuff together, and how much of that is a dependency, and how much of it is, hey, look, there's already the market for it with companies like Lucid and so on.
The cost curve is really interesting for semiconductor manufacturing, right? If you look at the companies that did this really well, like Taiwan Semiconductor, they'd start putting R&D into designing a new way to make chips before anybody could even use those chips yet. And then by the time that they had it ready to commercialize and start taking orders, it was the Apples, of the world that would say, hey, I want those super, super small, super awesome chips to put into our newest iPhone. And then all of a sudden you've got your iPhone that's running 300 apps at the same time, that's not draining all of your battery immediately because it's working efficiently. It's the same thing, like what we're seeing right now with a new way of producing semiconductors that might have a market in electric vehicles that's the first adopters. They can afford to pay those prices, right? If you're Lucid and you're charging $87,000 for your Lucid Air, you can afford, a little bit of money for your traction inverter components out there. But the idea would be, if you've got some early adopters, the electric vehicle industry, what else could this apply to? Air conditioning. Air conditioning is spinning motors, and needs delivery of power efficiently. How much money do we spend every month on our air conditioning bill? You guys don't worry about this. You live in California, but in Houston, we really worry about this in the summer.
Right? Hey, we've had a heat wave.
It was a long 2 weeks.
Yeah. I live by the beach, and it still hit 90. And that was like, and we got humidity, which we just didn't know what to do with.
But HVAC, HVAC is another industry that could this possibly, if we get the prices down low enough, could you do something like this with a completely new way of designing the chips that go into the smart homes? Things like that could be interesting. We're definitely not there yet, though. Market's still pricing this at 19 times sales. It's still greater than, I believe, what are we at? $15, $17 billion market cap maybe for Wolfspeed now.
15 right now.
50, yep. Okay, so not cheap. It's getting a premium, but it's also a pure play. It's punching the accelerator and putting a lot of money to work right now.
Yeah, and I'll just very quickly say, on going off the chart, I mean, it's very strong relative strength rating. The EPS, doesn't really have the earnings over the last few years here. But I mean, it comes up on our screens. I mean, this is one that is looking more attractive. And some institutional sponsorship too. Harbor Midcap Growth looks like they started purchasing a little bit of shares in the stock. So so versus like a QuantumScape, where that might need some time to base and build, and do a number of things for it to start surfacing up on our screens. Wolfspeed is one of those that comes through a number of screens when you run it through MarketSmith.
Yeah, and I think it's that relative strength line and the relative strength that is really kind of the key component there. Again, especially in the semiconductor space where you still have a lot of those stocks below their 200-day moving average lines, struggling there, and this one is clearly above its 200-day, its 50-day line, and so on. And again, for those of you that are not watching the video, you can get the video at investors.com/podcast, where Arusha is showing these charts. Let's go ahead and move on. You got another semiconductor one that some people may have heard of. That's ON Semiconductor, ticker symbol ON on this one. Another one where the relative strength is very powerful at new highs. Again, it's almost like what correction. This has just been tightening up the last few weeks. And this one has earnings. This one has some strong earnings growth. And what is the difference here between Wolf and ON? What are they doing, and why is ON kind of a little bit further ahead in terms of its earnings?
Yeah, this is a company that's been around for a while, right? Like we started with QuantumScape, which is zero revenue, still super early, super high risk. We talk about Wolfspeed, which has got some revenue, actually. It's got some earnings out there. Now we've got ON Semiconductor. This was spun out of Motorola back in 1999. So it's kind of this diversified chip company. Sells a lot of boring stuff, diodes, things to companies like Samsung and Dell. And, it's got this established business. But its CEO basically said, I think we should be serving the high end of this market. I'm kind of tired of selling you these really low margin things that we've been doing for 2 decades now. Why don't we go out and really have a profitable business? And he kind of turned things around and said, hey, electric vehicles is a great way to do this. And, even silicon carbide, I think we should be doing this instead. And so he's completely turned the business around. He's been divesting a lot of the gallium nitride assets that the company had before. It's been divesting a lot of the diodes and some of the transistors that they had before. And yet it's been acquiring some of its other companies, like it did with GT Advanced Technologies, not to be confused with ST Microelectronics that we mentioned earlier. But it's kind of realizing that silicon carbide is a much more profitable industry to get into. And so I think that ON Semi, probably is the lowest risk play of the 3 that we've discussed here. It's already established. You've got a leader who respects the profit margins, and that's directing his decisions of where he wants to go. And the chart that you show, this is the market embracing that, right? The market saying, wow, you're boosting your operating margins, you're boosting your gross profits. We want to invest in a more profitable company rather than a less profitable company. There's less competition here, so you don't have everybody chewing away at your pricing every day. They've certainly rewarded the company. It's had a great year for investors.
Yeah, I would agree with that. Well, first I should say that we actually own this stock in some firm accounts. It's right up there on kind of when you look at the screening from an O'Neill perspective, EPS rating of a 92, so outperforming 92% of the stocks in our database, an RS rating of 93. And yeah, Simon, you mentioned those earnings and sales. These are triple-digit earnings right there. So these are just monster earnings.
And that's not off of a penny per share. Sometimes you'll see that.
That's true.
We're up at $1, a buck earnings per share now.
And it is setting up. It broke out of a consolidation. It's hanging in there, kind of tightening up right around, finding support off the 10-week moving average, and then institutions. There are 3 institutions in this one in the IBD mutual fund index, and so you have Fidelity Contra Fund, right? So they've been building a position on this over the last few quarters. So there are a number of things that we look for. So we're looking for always these kind of great growth ideas that Simon's really good at finding, but then we're also kind of looking for a few other things. And in many ways, it's just to kind of try to slowly improve the probabilities for success when the market's ready to go too. So I think we all agree on this one, that this one does, like you said, Simon, this one out of the 3 has the most things going that growth investors look for.
Yeah, and perfect compliments to what you just said as well, Arusha, was, revenue is growing at 20% a year,
yes,
but gross profits are growing at 43% a year. You can see the focus on where the money's at, right? Gross margin just within the past year alone grew from 32% to 38%. So you see the strategy. You don't want to fight it out at the bottom of the market. Go where the money is, and that's certainly what ON Semi has done.
Yeah, and actually, let's just talk about gross margins a little bit. That's showing a company has that pricing power, right?
Mm-hmm.
Where they're able to, especially when the markets get a little bit harder and customers are going to be looking for different options. They're going to go towards quality, right? Talk a little bit about why gross margins are just so important when analyzing companies.
Yeah, and I apologize. I should have mentioned too that the numbers that I said were for their industrial and automotive segment, which is one of the gold star of the company right now. It's the one that they know they want to get into. This is, to your point, this is a company that there's nothing wrong with selling to the Samsungs and the Dells of the world, but they want to be selling to the Delphis and the Daimler Chryslers and the these automotive component manufacturers that are selling then to the automakers themselves. If you can do that, and it's a new industry, like we said, you get higher price points. If you're creating quantum computing chips, you're going to sell those for higher price points than if you're selling CPUs that are 30 years old. It just you want to go where the pricing can support it. And if Wolfspeed, we can say, is forward integrating their business, where they were selling the silicon carbide wafers and they want to be fabricating the components that go then to the automakers. Perhaps it's fair to say that ON Semi is going the backwards integration route, where they've been selling the components first, and now they want to make them out of silicon carbide instead and bring that in-house so they can get their own efficiencies higher. That's what you've seen at the acquisition. That's what you see. They're kind of trying to be like Wolfspeed at the same time that Wolfspeed is trying to be like ON Semi. There's probably enough of a market for both of them to win at doing that strategy.
Mm-hmm. Well, Simon, I think you've given our audience a lot of things to think about and research, and probably starting with just getting a periodic table and putting it down as a placemat at the table and learning all these different components. So great having you on the show again. And just as a reminder, again, you can find Simon at 7Innovator on Twitter, and also go ahead and give that spiel about your website as well and the code that people can use.
Sure, yeah, 7investing.com or 7investing.com/subscribe. If you would like to sign up and see all of our monthly stock recommendations, mine with this last month was in the veterinarian industry of all places, Justin.
Okay.
Outside of the typical companies I look at, but 7investing.com/subscribe and IBD if you'd like to use the promo code for 25% off.
And that's the number 7, right?
Yeah, correct. 7investing.
Yeah, and Simon, so you do a lot on your site. You do a lot of these videos too, right? You do kind of in-depth, kind of like, so for those who really like what you've been saying in the podcast and the way you analyze it, like me, I really enjoy, and I've learned a ton just in these last 45 minutes. You and your team are doing these kind of deep dives on companies, a few of them each month, right?
We do, Arusha. We fight it out. We hash it out, but we're all remote, so nobody can really, throw any haymakers at anyone else on the team. No, we do. I'm glad you brought it up because, so much of investing is to consider the risk profile too. This is something I've loved chatting with you about for several years now. What could go wrong with any one of these investments? QuantumScape is a very risky investment, and you want to make sure that everybody's aware of that right up front when you're looking at stuff like that. And we always say, what could go badly for any one of these businesses and what could go right. And then at the end of the day, what's your very favorite idea every single month? So that's where we end up with 7 investing each month.
Yeah. It's funny. I almost was thinking, back to our biotech analogy, it's almost like you've got the single drug company that's just kind of starting out versus, like an ON Semiconductor. It already has a lot of things established. It's got its pipeline. It's just trying to get that new drug, and maybe if it doesn't work out, it's not the end of the world. It still has all these other things to fall back on. So, yeah, a very, very interesting discussion, Simon. It's always great having you on. I'm sure we will have you on in the future again. So thanks for your time.
I had a great time. Thanks as always for having me, Justin.
Okay. And on the show next week, we're going to have Tom O'Halloran on. He is the portfolio manager and partner at Lord Abbott, one of the mutual funds that we really respect. You can see them on the IBD Mutual Fund Index. So it's going to be great to kind of get his insights into what he's seeing going on in the market and some reasons why he might be getting a little bit more bullish. Thank you so much for tuning in with us this time around. We'll see you next time. Take care. Make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.